On June 25th, 2002, one of the largest companies in America made a terrifying announcement. WorldCom had discovered a massive accounting problem. Not a small mistake, not a missing receipt, not a few numbers placed in the wrong column. Billions of dollars have been moved around inside the company's books, making the business look healthier than it really was. For years, WorldCom had been seen as a symbol of the future. It was a telecommunications giant, a company that promised to connect America, dominate the internet age, and keep growing no matter what happened. To ordinary investors, WorldCom looked like a winner. To Wall Street analysts, it looked like a machine. To employees, it looked like stability. And to the public, it looked like one of the great American business success stories of the 1990s. But behind the glass towers, the confident earnings calls, and the polished financial statements, something was deeply wrong. The numbers were not telling the truth. They were telling a story designed to protect the company's image, a story designed to keep investors calm, a story designed to make a slowing business look unstoppable. And when that story finally collapsed, the damage was enormous. The scandal would wipe out fortunes. It would destroy careers. It would help change the way America looked at corporate accounting. And it would turn WorldCom from a symbol of the future into one of the darkest warnings in business history. Because sometimes the most dangerous lie is not the one shouted in public. It is the one quietly hidden inside the ledger. WorldCom did not begin as a monster. It began as a fast-growing telecommunications company with huge ambition. During the 1990s, America was rushing into a new era. The internet was exploding, phone networks were expanding, data traffic was rising, and investors were desperate to find the companies that would control the future. WorldCom gave them exactly the kind of story they wanted. It was not just a phone company. It was a growth machine. The company expanded by buying other companies, one deal after another. Each acquisition made WorldCom larger. Each deal made the story more exciting. Each new headline made investors believe the company was moving closer to becoming an unstoppable empire. At the center of that empire was Bernard Ebbers, the company's chief executive officer. Ebbers did not look like the polished Wall Street stereotype. He had the image of a tough, self-made businessman. To supporters, that made him more believable. He seemed like a man who could build something real, a man who could take a regional business and turn it into a national powerhouse. And for a while, the market loved him for it. WorldCom's stock price climbed. Its reputation grew. Its executives were celebrated. The company became one of the great winners of the telecom boom. But success can become a trap. When a company is rewarded for growing fast, growth stops being a goal. It becomes a requirement. Every quarter, investors expect more revenue, more profit, more confidence, more proof that the dream is still alive. And by the early 2000s, the dream was getting harder to defend. The telecom market was weakening. Competition was rising. The internet boom was losing its magic. WorldCom was no longer growing the way Wall Street expected. But the company had already trained the market to expect perfection. And when a business becomes addicted to looking perfect, telling the truth can feel impossible. When growth slowed, WorldCom had a choice. It could tell investors the truth. It could admit that the business was under pressure. It could explain that the market had changed. Costs were rising, and the company was not as strong as people believed. Or it could protect the illusion. Inside the company, expenses were treated in a way that made profits look better than they really were. Costs that should have been counted immediately were pushed into the future. In simple terms, money that WorldCom spent to run the business was made to look like long-term investment. That may sound technical, but the effect was simple. On paper, WorldCom looked stronger. The company appeared more profitable. Its financial statements looked cleaner. Its performance looked impressive. The business seemed to be meeting expectations, but it was not real. It was accounting smoke and mirrors. A company cannot make expenses disappear forever. It can only move them, hide them, delay them, dress them up with financial language, and hope nobody looks too closely. At first, the trick may have seemed like a way to buy time. Maybe the market would recover. Maybe growth would return. Maybe the company could fix the problem before anyone noticed. But fraud has a dangerous momentum. Once the first lie is accepted, the second lie becomes easier, then the third, then the fourth, and soon the lie is no longer a temporary fix. It becomes the business model. At WorldCom, the hidden problem grew into billions of dollars. The company was not simply making an aggressive accounting choice. It was creating a financial illusion large enough to fool investors, analysts, employees, and the public. The numbers became a mask. Behind that mask was a company struggling to live up to the myth it had created. But every illusion has a weak point. Every fake empire has a crack somewhere in the foundation. And WorldCom's crack was buried inside its own books. The same records that help hide the truth would eventually help expose it. The truth did not stay hidden forever. In 2002, WorldCom's accounting practices came under pressure. Questions began to grow. Internal investigation and scrutiny revealed that billions of dollars had been improperly recorded. And once the truth started coming out, the company's image shattered almost overnight. The market did not see a small correction. It saw betrayal. The stock collapsed. Investors watched billions of dollars in value disappear. Employees who had trusted the company saw their savings, retirement plans, and careers put at risk. People who believed they were working for one of America's great technology companies suddenly found themselves inside a corporate disaster. WorldCom, once one of the most powerful names in telecommunications, filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. That detail matters, because WorldCom was not a tiny company gambling in the shadows. It was a giant. It had offices, employees, customers, executives, auditors, analysts, and investors. It was part of the American business establishment. And still, the fraud grew large enough to shake the entire market. The fall was brutal because the rise had been so enormous. WorldCom had spent years selling a story of expansion, dominance, and unstoppable growth. But when the accounting illusion collapsed, the company could no longer control the narrative. The same Wall Street that had once praised the company now watched it burn. The same investors who once believed in the dream now wanted answers. The same numbers that once made WorldCom look powerful now became evidence of the fraud. This was not just a failed company. It was a warning about what can happen when markets reward appearance more than reality. A warning about what can happen when executives fear disappointment more than dishonesty. And a warning about how fragile confidence really is. WorldCom had built an empire on belief. But belief is not cash. Confidence is not profit. And once people stop trusting the numbers, the entire structure can fall. WorldCom became more than a scandal. It became a lesson about greed, a lesson about pressure, a lesson about weak oversight, and a lesson about the danger of believing perfect numbers without asking how they were created. Bernard Ebbers was later convicted for his role in the fraud. The company that once promised to connect the future became a symbol of corporate deception. But the most disturbing part of the story is not simply that WorldCom lied. It is that the lie worked for so long. Investors wanted growth. Executives wanted the stock price to survive. Analysts wanted the story to keep making sense. Employees wanted to believe they were part of something secure. And the market wanted another winner from the telecom boom. For a while, everyone got the story they wanted. A company that never seemed to slow down. A stock that seemed to represent the future. A CEO who seemed to know how to keep winning. But the ledger was keeping score the entire time. every hidden expense, every adjusted number, every quarter protected by accounting tricks, every moment where the truth was delayed instead of admitted. Eventually, those choices came due. That is the thing about financial fraud. It can feel invisible while it is happening. There is no broken window, no alarm in the street, no dramatic warning sign flashing above the building. Just numbers, spreadsheets, reports, meetings, language that sounds professional enough to hide something rotten underneath. And that is why stories like WorldCom matter. They remind us that fraud often wears a suit. It speaks in calm voices. It appears in quarterly reports. It hides behind confidence, complexity, and reputation. WorldCom's collapse helped expose a dangerous truth about corporate America. A company can look successful and still be deeply broken. A CEO can be admired and still be leading investors toward disaster. A financial statement can look clean and still be hiding a crime. Because in finance, the truth can be delayed, it can be buried, it can be dressed up in beautiful reports and confident speeches, but it does not disappear. Eventually, every empire faces a ledger. This is the Noir ledger, where every fortune leaves a paper trail.